Zambia's central bank on Monday raised the statutory reserve ratio, the rate at which commercial banks keep funds in the central bank, following consistent pressure on the foreign exchange market. Francis Chipimo, the deputy governor in charge of operations at the Bank of Zambia, said in a circular saying to commercial banks that the statutory reserve ratio has been increased from 11.5% to 14.5%. According to him, the measure is aimed at relieving the persistent foreign exchange market pressure with a view to reining in inflation. He also added that it will take effect from November 13. To further discuss this, I'm joined by Cheelo, he's a developmental economist. Thank you, Cheelo, for joining me this morning.
Thank you for having me. It's a pleasure to be here.
Yeah. Well, first, let's begin with getting an overview of Zambia's economy. What are the major challenges and strides facing that particular economy?
The big one is many people know Zambia's debt situation. The country in 2020 defaulted on its external debt service payments and has been in a standstill position owing a number of external creditors, quite a big amount of money. So the debt overhang and the restructuring that has had to go with it, the fiscal austerity that comes with it, has been a significant challenge.
Well, let's look at the development now with Zambia's central bank raising the statutory reserve ratio to combat consistent pressure on the foreign exchange market. So what are the expected impacts on inflation, the exchange rate, and even the economy? That's raising the SRR by to 14.5%.
So starting with the exchange rate and inflation, I think the idea is to stabilize the local currency, as well as to slow down the inflation rate. So the inflation rate as of end of last month, October, had shot up from about 12% to 12.6%. So there's pressure building up in our economic systems. And one way of alleviating that pressure is to tighten monetary policy, including through raising the statutory reserve ratio, which is what the central bank has done. And the idea is to withdraw liquidity from the financial markets. And with that, the expectation that demand for money for transactions purposes will subside because of the withdrawal of money from liquidity. Essentially, that is supposed to slow down inflation, but also taper some of the demand that is coming for external expenditures, so import expenditures. And the idea, again, is to try and stabilize the local currency, reduce the volatility in the depreciation that we've seen in recent times.
All right, thank you for your thoughts. We'll take a break now. When we come back, we'll continue on that line of thought. Thank you so much. We'll be right back. All right, thank you, Cheelo, for staying with me. Okay, Cheelo, if you can hear me, kindly confirm. All right, I've been speaking with Cheelo, and we're looking at Zambia raising its SRR to 14.5%. And some have argued that when you raise your SRR, what happens is that you probably lower your overall liquidity. And when you lower overall liquidity, that's also going to affect production. And that's something that some persons are really critical about. And that's something I'd really like him to address. If you can hear me, kindly confirm. Cheelo.
Yes, I can hear you.
Perfect. Okay. Now, before now, you were talking about how that, increasing the CRR would probably translate to money not being in circulation and how that probably would affect production. And then you're also saying that to a very large extent, it's also going to help rein in inflation. So how do we strike a balance here? Because production has to go on really. And on the one hand, we're addressing a foreign exchange crisis. And on the other hand, we're also trying to rein in inflation. How do we strike a balance here?
Yeah, it's a tricky one. I think the main thing to think about is the trade-offs. So on the one side, inflation means an increasing cost of living. So you want to try and keep that low for households, for families, and things like that. But then on the other side, the challenge is inflation basically provides an incentive for manufacturers to manufacture and things like this. So really the issue is how do you create that balance? And that is what the central bank is trying to do. So they have increased the statutory reserve ratio and are hoping that this will slow down inflation, but at the same time will not slow down production and outputs too much, meaning that it will arrest the volatility in the exchange rate. It will arrest the escalating inflation, but will not be so onerous that it will completely demotivate manufacturing, agricultural activity, and all these other activities that are primarily demanding foreign currency to finance their inputs, and therefore putting pressure on the kwacha, the domestic currency.
Well, when we're talking about addressing these issues, I like that we're looking at monetary policies now. But what about fiscal policies? What fiscal policies, what are these things that the government is churning out, trying to also address these things so that we have a balance? Because that's how to actually strike a balance. What's the government doing?
Some of the fiscal policy moves we have seen, for example, domestic borrowing has reduced significantly. So if you remember, or if you would look back in what governments tend to do, is they borrow through the central bank. They would borrow by issuing treasury bills and bonds, so basically government paper. The more they do that, the more they drive up interest rates because they are competing with commercial banks, with private borrowers, and so on. So in that situation, you find a crowding out of private sector investments. But in this current situation, what the government is doing is limiting the amount of borrowing, limiting its borrowing appetite domestically, and therefore allowing interest rates to fall so that commercial banks now have to go hunting for other private sector clients to basically lend to. That's important for supporting private sector development, offering affordable credit, and so on. So that's a policy stance that the fiscal authorities have tried to do. Another aspect is debt restructuring, particularly on the external debt that I mentioned a little bit earlier on, trying to get Zambia back open for business by boosting investor confidence, by showing that we are on track and we are able to repay our public debts. So those are some of the fiscal moves that are happening in the background, I think.
Quite interesting, I would say, because it's not a good thing when the government crowds out the domestic market. It becomes difficult for corporates to raise funds. That's a good one. Now, beyond the increase in CRR, let's talk about factors that are contributing to the challenges in that segment of the economy, and how do you think the government can actually address them? Because it's good we know what the factors that are contributing to these things, because it's when we know this that we can then begin to, address them. Talk to us about this.
Sure. So we must understand that there are two elements around particularly the movements in the exchange rate. One is a short-term thing to do with what they call volatility. So volatility means the swings, the changes from day to day, from week to week in the currency are too much. They're too rapid. So a rapid depreciation like what we've seen getting into the month of November for Zambia. To stem that, the central bank would do various policy interventions, including sometimes selling currency to the market and so on, improving the availability of foreign currency, or as we have seen in this particular instance, raising the reserve requirement so that they reduce the demand for foreign currency for transactions purposes. But that's a short-term measure. The longer term of it is a structural issue about how much demand you have for foreign currency. How much do you need to pay your import bills for fuel, for fertilizers, for inputs into manufacturing and things like that. So the more dependent you are on those things, the more pressure you are putting on your domestic economy to raise the local currency or the kwacha cover. So what we have seen from a structural point of view is that in Zambia, most of the sectors are net demanders of foreign currency. Only the mine and a few, in other cases, a few other sectors would on the net be providing foreign currency to the domestic economy. Most of the other sectors like manufacturing, manufacturing, agriculture, transport and logistics, energy, they tend to demand more foreign currency than they are able to earn and contribute to the national economy. So a structural solution to that would be to invest in these sectors to find a way of increasing the local content of their production. So instead of importing inflation from South Africa, from China, from wherever, as prices increase, then you would increase substitution of for local products. So increase the local content and therefore improve the orientation of the economy towards exports, so that on the net, most of these sectors are supplying more foreign currency than they are demanding foreign currency. That would, on the long term, help to improve the appreciation of the kwacha, help to improve the strength of the kwacha. And it's not so much a measure for the short-term volatilities, but a long-term measure for improving the financial structure of the domestic economy.
Now, are these measures already being put in place by the government?
The government is pursuing some of these measures. If you look, for example, in agriculture, there's a big comprehensive agriculture transformation support program that is meant to, among other things, modernize and commercialize agriculture, improve the export orientation of agriculture. So looking into SADC and COMESA markets for agro-produce, there's a lot of aspects to do with value addition in energy, in agriculture. So agro-processing, manufacturing, and things like this. All these elements are, over the long term, meant to transform the economy so that we are more export-oriented and are able to earn the foreign currency that will, among other things, prop up the domestic currency, the kwacha.
Thank you so much, Cesar Cheelo, for your time on Business Edge today. I wish we could talk about this some more, but we'll probably have this conversation some other time. Thanks for coming on the show today.
Sure, thanks for having me. Bye-bye.